I'm not anticipating anything happening before second semester 2022.
Looks nice in the south of France, doesn't it? Let's talk more about this. Carsten Nickel, Teneo Intelligence Managing Director of Europe, joining us now. Carsten, at the moment, it feels like Europe is on track for recovery. We're going to get news from Boris Johnson a little bit later on. Despite high case counts in the UK, despite the Delta variant picking up sharply, the UK is going to continue to reopen. Is that the model we're going to see across the rest of Europe?
Well, yeah, I think it's the model that the rest of Europe is aiming for. Obviously, what we have to keep in mind is that, you know, you're still looking at that difference somewhere between 20 to 30 percentage points in terms of share of the population that has already received the second jab, where the UK is obviously leading continental Europe. And I think that is exactly what we're seeing reflected right now in terms of kind of the difference in tone coming out of London today.
Hello, day traders.
And
I'm going to place an order to sell short euro. And the price I'm going to sell, I've got this written 118.65. Okay? Please, if you are not on bank holiday, if you not live in America, you can trade right now because actually you can trade from anywhere because we trade Forex. So please place an order to sell short euro at 118.65. Okay? Have a nice holiday for American guys, for American customers, and happy Independence Day. Okay, guys? And I'll speak to you later when we'll get filled. Okay, stay safe.
That we're losing that race against time with a view to that roughly September target that has been set by many member states of the European Union and the Commission in Brussels effectively for having sufficient levels of vaccination in place, a situation that the UK probably finds itself in already. And I think in terms of social and political risks that we're looking at here, I think it would make sense for politicians to look back at the situation that we had last summer. We were forced to go back into that second lockdown scenario across Europe afterwards, something that obviously everybody hopes we can prevent this time. But in terms of social cohesion and the political ability of making that happen when it was required, I think we could already see that the ability was much lower in the second round.
Carsten, is that politically palatable? If you are Angela Merkel, if you are Laschet, if you are Emmanuel Macron, you've got elections coming up. Are you really going to allow yourself to be in a situation where it gets out of control again on the eve of an election?
Yeah, that's precisely the concern. Are you the one who allows that? And on the other hand, are you the one with a couple of weeks to go, say, to a German election, brings the news, actually, we're heading for a third type of lockdown, trying to make that happen. And I think that is the big fear, looking back at the experience of last summer, last year, how difficult that was engineering it for a second time. My concern is that the ability to engineer that for a third time, if it would become necessary, will be even lower than it was last time. And I don't really see any serious preparations going on, at least visibly, among European leaders. Obviously, nobody wants to be associated with discussing such a scenario at this point.
It's interesting, you talk to investors, particularly investors in the States, they firmly see Europe on track, on the same trajectory as the one we're seeing in the United States. Can we compare the two?
Again, I don't think we can at this stage. We're still looking at a couple of weeks, 2-3 months of real risks where we need to see whether continental Europe manages to catch up basically with the levels at least that we've seen in the UK, which are obviously much more comparable to where we are in the US. I think it is looking positive overall. But if you look at political reactions, just let's say over the weekend, last couple of days, to these increasing news about the spread of the Delta variant, I think it gives us an idea that we're not out of the woods yet.
I just want to pivot and talk about another subject, which is going to be, I think, really important later on this week. It looks like we're going to have a meeting between Emmanuel Macron, Angela Merkel, and the Chinese leadership, Xi, leading that conversation. How would you characterize the way you think that Europe is going to progress with this? It's under considerable pressure from both sides. The United States to take a more hawkish stance, from China to try and find some sort of middle ground and not focus on human rights. Can Angela Merkel, can Emmanuel Macron thread a needle in on this one? Because it is pivotal, particularly for German industry.
Yeah, and will they be around in about a year from now, right? In the case of Angela Merkel, we know this is not going to be the case, and in any scenario, looking at potential outcomes of the election in Germany, you're looking either at a green chancellor or at the very least at a green foreign minister and or finance minister. And we know, that party is looking at a much more values-driven approach in foreign policy, which would certainly not make things easier when we're looking at the relationship with China. So in terms of characterizing the relationship and where we are, I think it's very much incrementalism. And against the backdrop of what we've seen between Europe and China over the last 6 months, I think it is already positive news if we can say that both sides keep talking at this stage.
How do you see it developing? Because I say this is so important to German industry. In fact, German industry, European business leaders trying to urge their political leaders to take a pragmatic stance when it comes to China. Do you think that is possible? Or do you think actually we are heading kind of almost to a new Cold War? And I'm wondering where that would leave Europe.
No, I think it is possible, but I think it will require a lot of political management, and that will be obviously very crucial at a moment in time where, at least in Germany, we're going to see a real transition of power after 16 years of Merkel, basically balancing between these two competing demands that you were just pointing to. And that obviously counts only for domestic German politics. If you look at the European level, I think, there's a lot of talk about coming up with a China strategy and all that kind of stuff. The big problem obviously remains that many member states don't really see eye to eye when it comes to China. Again, balancing between these human rights concerns on the one hand and economic interests on the other.
Yeah, Jacob Wallenberg, the ERT, from the ERT, obviously a huge industrialist in Sweden, talking about the fact that we have to make this work. And it's interesting, business is really getting quite concerned about how this relationship is going to evolve. What do European consumers think about what is happening here? How engaged do you think they are? And I'm wondering how that ultimately filters into this process.
Yeah, I think we have to differentiate here. But it is clear that we're looking at a rising consumer class, new middle class growth, and you see the equivalence of that in the polls across Europe in support for green parties, modernized liberal parties such as Macron's in France, modernized center-right parties like Angela Merkel's over the last couple of years in Germany, where I think there is growing pressure for a more, let's say, conscious kind of consumerism and so on. But of course, at the same time, especially in the small and open export-dependent economies of Europe, there remains a very strong core of manufacturing-driven growth, where consumers, where employees and voters at the end of the day will have a strong interest still at close ties with China.
Carsten, we're going to leave it there. Always interesting. Always appreciate your time. Thank you very much indeed. Carsten Nickel, Teneo Intelligence, Managing Director of Europe. Thanks for joining us. Coming up, another one, ransomware. Thousands of companies falling prey to another ransomware attack. Robert Lee, Dragos co-founder and CEO, telling us what's behind the latest attack. And it's basically a string of cybersecurity attacks. Significant vulnerabilities clearly exist. We're going to talk about all of that. That's coming up. This is Bloomberg.
morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things have to be, you have to be mindful about that. But I think it's incredible what's been achieved so far, but, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
So here we go again. A massive ransomware attack has hit more than 1,000 businesses. Another ransomware attack. The group blamed for the May 30th attack of meatpacking giant JBS is believed to be behind this latest round of hacks, targeting companies which provide IT services to small and medium-sized companies. Joining us now, Robert Lee, Dragos CEO and co-founder, specializes in this area, sits on a number of different panels and boards advising government and industry. Robert, thanks for your time today. What do we know about this attack? Talk me through the level of sophistication, what was targeted, and what we can learn from it.
Yeah, so absolutely, like you said, it's a managed service provider that got hit. And unfortunately, what that means is that company is providing services and software to companies who then provide additional services to follow-on companies. So when that company gets hit, the initial companies of 30 to 40 entities getting impacted doesn't seem that large. But when you realize each of those have hundreds of customers, you're easily getting into hundreds, upward of 1,000 victims across the world. As we saw in Sweden, the co-op got hit, and they had to shut down 500 stores as a result. So this is, without a doubt, one of the largest ransomware attacks we've ever seen.
Is revenue, getting money, Bitcoin, the objective here, or is there something else going on?
By and large, it's absolutely criminal in nature for financial purposes. And the payments, which used to be $500, $5,000, $50,000, now we're seeing $50 million payments. In this case, they've asked for $70 million to be able to unlock all the different systems impacted around the community. So when you see criminals operating out of countries as a safe haven with no real consequence to their actions, getting paid in tens of millions of dollars per case, you're absolutely going to fuel those operations, and we're going to see more and more and more of these cases.
If the bill is paid, how quickly do these services come back?
Yeah, generally not very fast. So the decryption keys usually work. They need to be able to have confidence with the consumer, right, the victim, that the keys are going to work so that people pay. But there is some issues sometimes with getting the keys to work to actually get access back to your systems. But more importantly, even if you get access to your systems, you still have to restore those systems and the networks and the business. You still have to then increase the security in that company to make sure it doesn't happen again, because there are a lot of repeat offenders here. And very often you're talking about months of restoration. We've seen this with many companies around the world where they pay even on day one or day two of the attack, and still they're down for months. So it's becoming an issue that's affecting global economies. It's affecting healthcare systems, people getting turned away, from hospitals with different attacks. We saw the Colonial Pipeline attack that stopped fuel delivery to the East Coast of the United States. It's just getting untenable, and governments at some point are going to have to take a more strong approach on these criminals.
What does that look like?
Yeah, well, the first thing has to be some level of international cooperation to make sure that the countries that these criminals are operating out of can't be a safe haven. So sometimes we talk about them being Russian-based, sometimes Eastern European-based. Either way, there's a lot of these groups coming out of that region. And you try to get to some agreement where criminals that are operating against foreign countries and foreign businesses in those countries do still get prosecuted and still do go to jail. President Biden and President Putin tried to talk about this to some degree in their latest meeting, but I don't know that many people in the information security community are really holding a lot of confidence in those discussions at this point.
Okay, so if you don't believe that those discussions are really going to go anywhere, and I'm a CEO, a CTO of a company, I'm trying to figure out, I haven't been hit yet, but I'm seeing everybody else getting hit, so I'm wondering what to do. What do you do?
Yeah, the very first thing is have a plan, because it is very likely going to happen to many businesses. So for all these companies, they need to think about how they're going to respond to these incidents. Are they going to pay? We're not. It needs to be one of the first conversations. Where are their security gaps, and how can they try to invest more in cybersecurity to make sure they reduce the frequency and, more importantly, the impact of these attacks? And most importantly, how are you going to restore? So if an attack happens, regardless of how it takes place, what is the business continuity plan? What is the disaster recovery plan? How are we actually going to be able to get back up and running? And how do you communicate to your consumers, especially for some of these businesses that provide services like grocery stores and healthcare providers and similar? How do you get that message out to everybody about what has occurred and what to expect next? Oftentimes it's the communications piece that lags the most.
Are US companies, European companies, spending enough? I don't mean on paying bills. I'm paying the ransomware attacks. I'm talking about making sure that their systems are hardened to this kind of attack, because a lot of these attacks seem to be coming in via sort of third-party subcontractors, IT specialists, which you don't normally expect trouble to come from that direction.
Absolutely. And so generally speaking, there are those companies that obviously spend enough and you never hear about them in the news. They've planned very well. They have good response plans. They've thought through this, and by and large, they're okay. But the vast majority of companies generally don't fall into that community. So there are a lot of companies that aren't investing enough, and it's not that they're incompetent. If you look at a lot of the guidance that these companies have received over the years, a lot of the guidance is how to prevent attacks. And eventually prevention is going to fail. Not a lot of the guidance is on how to detect and respond to these incidents when they occur. And so that's usually where we see a lot of the gaps, or when these companies haven't planned through the incident in the first place or haven't thought through how to restore. Sometimes those measures they put in for security are misaligned with where they need to be. And that does account for most of the cases that we see. Now, in this case, it's a little different, whereas you mentioned it's a managed service provider that got compromised. And these small and medium-sized businesses aren't going to have the resources to invest in all the different security efforts they need to do. So they should be using managed service providers. However, those managed service providers and the people with more privileged access, if you will, they do need to think very, very closely about their responsibilities and how they're taking care of their customers to make sure that the impact of these incidents aren't as big as we're seeing now.
All useful. Robert, thanks very much indeed for your time. Robert Lee, Dragos CEO and co-founder. More ahead on this. We'll talk about this over the next couple of hours as well. It's a big deal. We'll get more as we work our way through the program. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Let's check in on the Bloomberg First Word News. I'm Laura Wright. The global economy is now left to guess at how much oil it will get next month. That's because the OPEC standoff between Saudi Arabia and the United Arab Emirates hasn't been resolved yet. The Saudis want OPEC and its allies to increase production over the next few months and also extend a broader agreement to the end of next year. The UAE wants better terms for itself and argues that the proposed agreement to extend quota limits to the end of 2022 is unfair. In South Florida, demolition crews used explosives to bring down the damaged remaining portion of that collapsed condo building. Authorities say they needed to do so rescuers searching for victims could gain access to new areas of the rubble. So far, the remains of 24 people have been recovered. 121 others are still missing. President Biden has all but announced an end to the pandemic in the US. He celebrated what he called a heroic vaccination campaign on the country's Independence Day holiday. The president missed his goal of having at least 70% of adults in the US getting at least one dose of a vaccine. The total now is 67%. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg. Guy.
Laura, thank you very much indeed. Let's pick up on what Laura was saying there about what the president was talking about over the weekend. Certainly celebrating the 4th of July weekend, though, as Laura was saying, missing some of the targets. I think that could come back to be quite significant. We're watching very carefully how the Delta variant is evolving here in Europe. We were talking about that earlier on. Today, though, markets tracking a little bit higher. Equities certainly getting a lift today here in Europe. But with the US closed for the 5th of July, we are seeing very, very light volume here in Europe. Nevertheless, the equity markets, the Stock 600 up by 0.3%. Hope I can see that. The FTSE 100, sorry, not the FTSE 100, the pound up by a few percentage points as well. We're waiting for Boris Johnson to make an announcement a little bit later on. Banks are higher, basic resources are higher, travel and leisure higher. We're going to be back to the OPEC story in just a moment. This.
financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
Monday, the 5th of July, 3 p.m. in the UK, 10 a.m. over in New York. I'm Guy Johnson. This is Bloomberg Markets. Quick look at where we are with the markets. Little less of a focus on what is happening today. Very light volume. The US is out. It is the 4th of July, 5th of July holiday, as a result of which super light volumes. The FTSE is up. It's being held by the miners. The oil stocks are tracking higher as well. The DAX fairly flat. The CAC's catching a little bit of a bid. Zurich fairly flat as well. I think that is the narrative. You are watching what is happening in the commodities with a great deal of interest today because that really is the story that everybody is watching out for. As a result of this split, we've got really at the core of OPEC, OPEC plus, and it shows no sign of healing at this point in time. We've basically got a bitter spat between Saudi Arabia and the United Arab Emirates. It continues to show no sign of healing at the moment. They're taking to Twitter, and over the weekend, they were taking to the airwaves as well on Bloomberg Television.
Okay, traders, as you can see, position opened on Euro. It's a short position at 118.65. Okay, I'll show you where we opened short positions, just right here. Okay, and it's moved down, and right now looks like soon I will place stop on profit for Euro. Okay, I'll adjust. Maybe I will have time, and I wouldn't have to switch off my mic. All right, just to say, I'm waiting until it will move further down in order to place stop on profit for Euro. So in this case, if something going to happen and it will change direction, I will not end up in loss. So right now I'm placing stop on profit for Euro at 118.63. It will give us 2 pips. In our case, it will give us £200 in profit. In your case, it will give us profit per pip, 2 pips, whatever you decided to invest through your broker. And you needed to find out how much broker pays you per pip. This profit you will get from trading Euro. Okay, guys? I'll speak to you later. Good trade.
In August, and then another 400,000 in September, and so on, either until the end of this year or, potentially until September next year. Personally, I think if they agree something out all the way out to September 2022, that's going to get revised as we see whether Iran comes back or not and how demand materializes over that period. But there is this, possibility if a deal can be reached, that we will get more oil. At the same time, there's the possibility that if a deal isn't reached, then we stay where we are at the moment. The increase that they'd already agreed for July, which was about, I think, 850,000 barrels a day, that goes through. But then after that, there's no more. If the projections of strong demand growth in the second half of this year prove correct, then we're going to see a world that's short of oil. Stockpiles are going to continue to be drawn down, and that's going to be quite bullish. The third possibility is that we don't get an agreement, everything falls apart, the OPEC Plus group of countries ceases to exist as a cohesive unit, everybody is then free to pump as much as they want, the UAE moves production towards its claimed capacity of close to 4 million barrels a day, Saudi Arabia opens the taps, and we're back where we were in April 2020 with prices crashing. I think everybody wants to avoid that. I think they're so scarred by what happened last time. But things could go anywhere from here, and I think that's why the market is doing what it is doing, which is actually moving very, very little.
Yeah, really hard to get a read on what is happening with prices at the moment. It's not a useful indicator, as you say. Everybody's struggling to understand what is really going on behind the scenes. Bloomberg's Julian Lee, thank you. Let's get another voice on this. Amrita Sen, Energy Aspects Head of Research. She leads analysis and forecasting of crude and products markets. Amrita, you can get into the weeds on what is happening with the oil market and how many barrels we're going to have pumped and who's going to be pumping them and where baselines are. What I'm trying to really understand here is, what is this argument about? Is it just about oil? Is it about baselines? Or is it about something more, something wider? Because if it is, then it almost makes it more intractable.
Yeah, I think exactly. You are asking the right question, because clearly it's not just about oil, right? And this is not the first time the UAE has raised this. If you remember, late last year, there were similar concerns raised by the UAE. There were also voices from within the UAE that was reported. Even Bloomberg ran stories about how they wanted to leave OPEC. I mean, this is wider, right? This is about slight differences in foreign policy between the two leaders, about the importance of UAE in the region, and UAE ultimately wants to be taken a bit more seriously. So yeah, to your point, it does make it more difficult because this is not just about oil.
Okay, so if that is the backdrop, what do you see happening here?
It's a really tricky one to call because, like you mentioned, both ministers have now gone on record. It's become quite public, the spat, and they were on Bloomberg TV yesterday talking about this. So when it is out in the open, then you need a deal which is also face-saving for both parties, and I think that's where the difficulty lies, right? Both sides need to be able to go home and say, this was a win for me. And right now, neither side is willing to move. I agree with Julian in the sense that neither side wants the deal to collapse. What happened last year in April, the March meeting, and what then subsequently happened to prices in May, everyone remembers that very, very well. But this might take longer. I'm not 100% confident that we will necessarily get a decision today.
Brent crude 76.07, as Julian says, it's going nowhere. What's the plus and the minus on that number, depending on a potential outcome here?
The tricky thing is that unlike the last deal, there is a deal in place right now, right? We've never had OPEC come up with a 2-year deal in the past. So what this means is that if there is no agreement, the fallback should be the existing deal, so no production increases through to April 2022. On paper, at least, that is extremely bullish. The market is already tight. So there's going to be no incremental oil, and Iranian barrels don't look like it's coming back anytime soon either. We don't think it's going to be before Q4. So that should send prices well above $80, but I think market is going to be quite worried about, what does this mean for OPEC Plus? What does this mean for the future? Could it be free for all, because everybody is worried? So that's where I think it's going to be tricky. So I think time spreads, we're going to get much steeper backwardation, but flat price might just stay here because the market's going to have those opposing concerns.
If you get that second scenario, I appreciate at the moment there's kind of 3 scenarios, one of which is you get a deal, I don't know, 400, 450, depending on where the baseline is, kind of that is possible. There's the fallback position, but as you say, there is that third scenario of everybody just going out there on their own and pumping as much as they like. In that scenario, what does the oil price look like?
I think, of course, then you are going to go back into the 50s, I would say. But I will say one thing. The 5.8 million barrels per day of spare capacity that everybody talks about, that is just on paper. We've done a lot of detailed work on this, and we don't think there's much more than 2.5, really pushing it would be 3 million barrels per day. There's been a lot of productive capacity loss. So like next year, we really think it's going to be 2.3 that comes back. So that's why I don't think the downside is going to be as dramatic, and demand is going up. So yeah, there'll be a knee-jerk reaction, but we shouldn't be going down much further. And again, Iran keeps getting delayed, and demand is definitely improving.
Amrita, does OPEC Plus believe the big shale producers when they say they're going to be disciplined? Because if they do, they can push the price up a little bit more. There's a little bit more wiggle room here without shale coming back aggressively.
I think they do believe the bigger shale companies. They definitely have dialogue ongoing with them. The problem, of course, is that the privates have been increasing rigs and production has been ticking higher. Nothing major. They are keeping an eye out, and Russia has made that pretty clear that, shouldn't just forget about the fact that U.S. production is rising, even though the bigger guys are keeping rigs pretty stable. But yes, I do think it gives OPEC a bit more wiggle room. Anyway, the deal in place, and this is why Saudis are saying, look, let's extend it till end of the year. Yes, 400 a day gets you through to September 2022, but it gives you 3 months potentially if the market weakens. And that could be Iran coming back, potentially shale surging, or demand weakening, right? So they need that flexibility, and that's why they are pushing for the deal to be extended to year-end next year.
Coming back to how the market is structured and shaped, are you expecting a significantly more volatile energy price going forward?
Yes, absolutely, given the lack of spare capacity. I mean, we think global spare capacity goes down below 2% by the end of next year. That's an incredibly thin margin at a time when shale production isn't as responsive. We haven't had that in well over a decade. So I think you are going to see very volatile prices and a bias to the upside.
Amrita, always a pleasure. Thanks for jumping in and joining us and giving us your perspective on this. Amrita Sen of Energy Aspects, thank you very much. We're going to talk about economic, if I get the words out, economic implications of what these higher oil prices might mean for the global economy, Europe's economy. Simon Wells, HSBC Chief European Economist, joining us next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
Curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Let's get back to that oil story. OPEC Plus if we do get significantly higher oil prices, what's that going to mean for the global economy, Europe's economy, the UK's economy? Joining us now to discuss all of that and plus more is Simon Wells, HSBC's chief European economist. Simon, we don't know what's going to happen at OPEC. The market is very much kind of sitting on its hands. We've got a kind of 76 oil price on Brent. What would $10 a barrel on top of that mean for your economic models, do you think?
Well, Guy, everyone loves a rule of thumb. And the rule of thumb for Europe is that 10% on the oil price takes 0.1 off growth at the maximum point and probably adds 0.2 to the annual inflation rate in the Eurozone and 0.1 in the inflation rate in the UK. So we've had a near as damn it 20% rise from the end of Q1. So we're looking at maybe 0.4 on Eurozone inflation, 0.2 on UK inflation. If we go another, if we get to sort of 80, 90, we go another 10% or more higher, then it's another 0.1 off growth for every 10% we move up. Now, of course, these are only rules of thumb, but economists, the market, we like a number to get our head around. It's usually 0.1, and in this case, the answer is 0.1 again.
Usually, you would look at Europe and think that it is relatively insulated from things like this, in as much as there is a high degree of taxation that is applied to gasoline, to petrol, and as a result of which, actually price rises at the pump, and I'm talking about the pump in Saudi Arabia or the United States, doesn't actually have much of an impact when you're filling up your vehicle. Is that the case? Is Europe actually, when you look at what is happening broadly with Europe, going to be more insulated? And therefore, when we think about the European recovery, this is something that's not going to knock it significantly off track, as you say.
I think that's right. Obviously, it depends on the country. Spain is a little different. You get a bit more pass-through there. But I think we have to look at it in context. So if you take our Eurozone inflation forecast, for example, we've got a 2.9% peak in November now on headline CPI. It's only there briefly. But if you start adding 0.2 to that, you're suddenly at 3.1. This is coming up ahead of a German election. That's the sort of thing that could really make the ECB's life very, very difficult. So I agree, it's probably not going to affect the growth outlook that much. But if you're a central bank at the moment, given you're trying to persuade everyone that this inflation is going to be transitory, that 0.1, 0.2 as a result of an oil price, I mean, I bet their ECB in Frankfurt's praying that it doesn't happen and an OPEC agreement is struck.
Can I get another piece of the puzzle and your take on it? We've just had a virtual meeting between Emmanuel Macron, Angela Merkel, and the Chinese leadership led by Xi. The data out of China are certainly starting to show a slowdown. We've got a tense relationship between the EU and China. We're getting these headlines, they're crossing as we speak. Apparently they discuss trade, climate and biodiversity. But let's focus on what is happening with the trade and the economic data. How carefully are you watching what is happening with the Chinese data in terms of the way that it's going to impact your thoughts on the way that particularly the more trade-orientated economies like Germany and Sweden are going to be positioned going forward? Are you starting to get concerned that actually the Chinese slowdown or the rate of change involved could actually start to have a material impact here?
Yes, it could. I mean, first of all, I think one lesson from China is, of course, we get the inflation data out on Friday. Although PPI is likely to remain very, very elevated, we are seeing some limited pass-through from the current commodities and PPI in China into Chinese consumer price inflation. And I think, there are lessons for the rest of the world to be drawn from that. If Chinese commodities aren't feeding through to Chinese inflation, should we be really worried about European or US inflation? So I think that's point one. The second point, as you say, focusing on the trade, is no doubt that European exports to China in particular were going gangbusters earlier this year, late last year. That is definitely going to wane. That means that in Europe, if you're getting less of an impulse from net trade, obviously you want domestic demand to pick up. Now, that should happen as the service sector unlocks. We're expecting it to happen, but we shouldn't underestimate the fact that Europe's going to have to look maybe elsewhere for some of its export markets. So particularly for the Germanys of this world and the big exporters there who are already suffering from speed limits, it could be an additional weight.
Simon, Boris Johnson, 5 p.m. a press conference in London, expected to signal the final reopening, the terminus reopening here in the UK. How much of what we've already seen in terms of the reopening is already in the data? How much more should we expect?
We've got UK GDP on Friday, haven't we? I don't think it will grow at quite the pace that we got in the first set of unlocking in April, but the return to indoor dining and indoor sports should give us a pretty good number for May. And then sequentially, the unlocking in July, it's more marginal to the economy. So I think most of the big boost sequentially monthly is behind us. We should get a very strong Q1 number for the UK. The question, of course, is going to be relating to what we were just talking about. How much is this wall of demand hitting a supply side for the UK economy that's still slightly constrained? And what's that going to mean for prices?
Yeah, and how does the furlough scheme unwind, and what happens with the labour market around all of that? Simon, we're going to leave it there. Always appreciate your time. Thank you so much. Simon Wells, HSBC's Chief European Economist. Up next, we're going to be back to what I think is a fascinating story. Beijing ordering Didi and other companies to halt new user registration, app stores to remove Didi's services from their platforms. This just days after the Didi IPO in New York. We're going to discuss this next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get back to China's tech crackdown. Beijing banning ride-hailing giant Didi from app stores just days after its US IPO. Our next guest says until the regulator takes its foot off the gas, valuation multiples on large Chinese tech companies will continue to compress. Joining us now from Dubai is portfolio manager Sharif Faha, Safe House Capital portfolio manager. Sharif, talk me through your assessment of this situation. We have a massive high-profile IPO. Days later, the Chinese regulator steps in and basically cuts Didi off at the knees. How, as a US investor, should you be reading this situation?
So, the way we look at it, Guy, is, today the regulator's making it clear that no matter how big you are, and no matter who you are, and no matter who's in your cap table, whether it's a US investor, a European investor, anyone, if you do not abide and, give in to their control, they will make an example out of you. And that's what we're seeing with BD today, right? BD went listed a couple of days ago, then we find out they're getting investigated. Next thing you know, the app is removed from the App Store. And so, this is a warning sign to all investors, but really to all the companies out there that if you have too much data, they want to have control and they want to have oversight. And so that's what we're seeing.
So what does this mean for future IPOs? If you're a Chinese company at the moment, you are large, you have significant amounts of data, what happens next? Can you list in the United States? Will US regulators allow you to list in the United States?
Yeah, it's a great question. So I think, first of all, if you're a large cap technology company in China and you want to list in the US, the first thing you have to do is you need to go to the regulator and say, can you please check everything and make sure we're abiding by all laws and requirements, because we don't want to get taken down right before or during our IPO. That's number one. Number two, I think we will continue to see US listings, Chinese listings in the United States, but I think a couple of things will happen. The discount we see on Chinese equities will continue to kind of increase. And we're already seeing that. And I think the rate of Chinese IPOs may slow, but in reality, I don't think that's a concern. I think it's the valuation that they'll get. So take DD, for example. There was a $100 billion number floated for them, and they came out at a $67 billion valuation. We're already seeing that. So now that discount should accelerate and widen, actually.
Do you think that US regulators will also put greater health warnings, will require greater health warnings in terms of the risk?
So it's hard to tell the US regulator stance today. I think, obviously there is this kind of, US being tough on Chinese equities and kind of Chinese stocks with their, accounting requirements and things like that. That pressure will definitely continue. Whether US regulators create some sort of safeguard for foreign investors in IPOs, I think that's very complicated. I don't see that happening. But at the same time, I think global investors are learning they're learning from their mistakes, and they're learning it the hard way, is that if there's a risk with the regulator in China today, nothing is off the table. You have to tread with caution.
Sharif, on that note, we will leave it. Thank you very much indeed for your insight today. Very useful. Sharif Faha, Safe House Capital Portfolio Manager, joining us from Dubai. Coming up, we're going to take a look at what is happening with global food prices, inflation. The Farmers Business Network out with a new report. We saw the USDA report last week, really causing a huge spike higher. US farmers not planting as much as everybody thought they were going to be, particularly in corn, particularly in soy as well. We're going to talk about what that means. Are US farmers just being disciplined? What do they see in terms of their markets? That's the focus next. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. a community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Up past the out, live from London, I'm Guy Johnson. This is Bloomberg Markets. The global food prices extending their recent rally to the highest level in almost a decade, heightening concerns over rising grocery bills at a time when economies are struggling to overcome the pandemic. Yes, we're talking about inflation here. Joining us now, Kevin McNew, Farmers Business Network chief economist, just putting out a report, a new report, basically finding that strong prices and good planting weather likely help push corn acreage numbers above the USDA's March reading of 91.1 million acres. Kevin, great to see you. Thank you very much indeed for joining us. Look, the USDA report last week caught a lot of people on the hop, particularly when it came to corn and beans as well. The market was expecting farmers to be out there planting more. They didn't. What is your perspective on this?
You know, Guy, we had our farmers tell us back in mid-June from a poll we did, over 2,000 farmers across the Farmers Business Network. And what they said is there's a lot of opportunities out there in other crops. And so while the market's hyper-focused on corn and beans, we saw winter wheat plantings just really skyrocket in the fall planting period. And that took a lot of corn bean acres off the table as we went into spring and summer. So I think the market got it wrong, and our farmers were kind of helping us understand what was going on, which was not that much corn and beans is what the market thought, hence the big run-up on prices June 30th.
So why are they taking this approach? Why are they planting more winter wheat? Why are they doing things differently?
Yeah, so you have to go back to what circumstances were in the fall of last year. We were just sort of coming out of the real deep, dark days of COVID. Prices were really depressed, and winter wheat was kind of the only thing that was sort of getting some positive price movement. And so farmers were able to kind of switch it up and plant a lot of winter wheat, especially in key corn-producing states. We saw about 2 million acres of winter wheat come on in really heavily corn-producing states. So that told us early on that, you know, farmers had kind of played their hand already in the fall, planting winter wheat and not planting corn or having the option to plant beans this spring.
We're obviously spending a lot of time at the moment. In fact, we're hyper-focused on what is happening with the weather. We've seen, obviously, hugely hot weather recently, but earlier on the year it was completely different. Huge volatility in the weather that farmers are having to deal with right now. What impact is what is happening kind of recently having in terms of yields, in terms of what farmers are doing? What is this super hot weather doing to their outlook?
Yeah, you're exactly right, Guy. It's such a bimodal year this year. The northwest part of the country is just super hot, really dry. Southern and eastern parts of the country are super wet. And really kind of in the middle where it matters for grain production is where we're hyper tuned on what the weather is going to be. It's been dryish in key states like Iowa, certainly South Dakota, North Dakota, Minnesota. Those are areas, the upper plains, where we've seen a lot of this additional acreage come online this year. So, you know, while we have more acres than we did last year, they're really in kind of these drought impacted areas. So as we look at, you know, here we are, 1st of June, this is really the key element of growing season for U.S. corn producers and grain producers. And, you know, we see weather forecasts that look a little more promising in the next 10 days. We'll see if those weather forecasts come true, because they haven't been doing very well with really this split personality of weather across the U.S.
What's happening globally? Like, we're looking at a map right now of what is happening with the weather globally. A little to the east of where I am now, Ukraine, obviously a huge producer as well. You've got South America. What does the competition look like right now?
Right. It's, as let's start in South America. That growing season is just kind of wrapping up, and it's been a real pill of bad weather for Brazilian farmers in particular. They had drought impacting the early part of their second season safrinha corn crop. Now, as they're trying to get to the end of the finish line for their growing season, they had a big freeze event. So we're really seeing that big corn crop that competes in the world market against the U.S. Really kind of ratchet back. You mentioned Ukraine. They're having a good growing season. They're getting the benefits of good moisture this year, unlike last year. So it's kind of a who has the yield, who doesn't have the yield this year. And you're right, Ukraine is probably one of those stories where we're going to see more export competition in the coming year.
Kevin, quick question on another key input for a lot of farmers, and that is fuel and how they get their crops to market and all those kind of factors that we often don't think about. Oil prices have started to shoot higher. How does that get factored into the thinking of farmers? Is there anything they can do about that? How many farmers, for instance, hedge forward? I know they hedge forward in terms of selling forward some of their crops, but what else can they manage in terms of some of their costs?
Yeah, good point. So fuel and energy prices in particular kind of have a two-pronged approach or two-pronged impact on farmers. One is that, as you mentioned, just fuel costs. But secondly, energy impacts fertilizer costs, and that's a really big component of farming. And so, we've had a lot of discussions with our farmers about trying to lock in fertilizer costs early, not just this year for this growing season, but even next year, as we think prices will continue to be reasonably strong. We want those farmers to get some protection so they can do it on cash forward contracts. Some of the more advanced farmers, you're right, they will turn to the derivatives markets and lay off some of that risk exposure.
Just more broadly, Kevin, it does seem that a lot of things are getting more volatile at the moment, and trying to get an idea of kind of where prices are going to be 6 months, 12 months, 2 years down the road seems to be getting harder and harder. Is that what we're going to see in the ag market as well? Are we going to see more volatility?
Yeah, I mean, volatility has always kind of been embedded in the agricultural markets, and we're just in one of those periods of heightened volatility. Obviously, last year's COVID and demand destruction really kind of played into it. But then we've had weather problems along the last year. As we look ahead, China is just a major player. They stepped into the corn market in a big way that really no market participant saw. And so you're right, we're going to see volatility certainly for the next 6 to 18 months. But, we'll probably see prices moderate beyond that, because we'll start to ramp up production in some of these other countries as well as in the U.S., at least next growing season potentially.
Enjoy the rest of the holiday, Kevin. Thank you very much indeed for your time today. Greatly appreciated. Kevin McNew, Farmers Business Network Chief Economist. Thank you very much indeed. What are we going to be doing next? President Biden virtually declaring victory over COVID-19 over the weekend, but concerns remain over the Delta variant, which is spreading in states like New York, in California. We'll talk about the numbers next. This is Bloomberg.